Number 5, doing this on a Monday. Might make that a habit. Not 100% sure yet. But let's talk a little bit about mortgage rates. So here's that bond chart I've showed you before. Green is good for rates. Red is bad. This is the last 90 days. As bond prices go up, rates come down, and vice versa. As bond prices go down, rates go up. So as you can tell, make it a little bit larger here. Things were going well. We had some real chaotic days there, end of or middle of March mostly. Things got better, and you can see now out here to the right, we've kind of stabilized. So back then was when the Fed made their move right between those 2 terrible weeks, and then things got better. And so we're pretty much have leveled out here. Nothing too exciting. This is actually today. Each bar represents a day, by the way. Yeah, so that's what bond prices have been doing. So that's good for rates. I have another chart to show you. Boom. This is just the opposite. This is rates, mortgage average 30-year fixed mortgage rate nationwide in the past year. So you can see we were a year ago, we were a little bit above 4, kind of hovered most of last year between 3.5 and 4, and this year dipped down below 3.5. There's that chaotic week or two a few weeks ago, that spike when rates jumped back up. They actually went up a lot higher than that, but this is a weekly average. So they've come down back right above my picture, and they are kind of level. So we're hanging out between 3 and 3.5, mostly on 30-year fixed rates. So what else has been in the news? Well, unemployment has been in the news. 1 out of 5 workers are out of a job. Huge. This spike is just going to be confounding graph makers for years. It's such a huge spike, and although the unemployment weekly numbers have dropped from the high 4 weeks ago, we still huge numbers of unemployed, and that is just the basis of housing, and will just be crushing housing for months to come. Of course, the question is how quickly does the economy rebound, and how quickly do these people get back to work? Next slide. Well, what has that done so far in housing? So here's a little slide from our friends at Redfin. The blue is 2019 new listings coming on the market in the Houston region, and the red is 2020. So you can see this goes just to the first week or 2 of April, but new homes available, new listings have fallen. So tremendously, another huge spike in the chart for new home listings. And another thing to show you, let me see, I'm getting better at this software. Not expert yet. So if you're a buyer or you represent buyers, what does this mean? Well, there's fewer lenders. Lenders are pinched. There's some that have gone out of business already, and some that are cutting back. There's fewer homes on the market, so that's bad. Tighter underwriting guidelines. Everyone's starting to tighten up on the lower credit scores, and there's been some different products that have dropped off the market. You might have heard about jumbo being an issue for some lenders. So that's the bad stuff for buyers. Good stuff for buyers. Hey, the rates are low. There's less people looking at the houses that you're looking at. So does this mean it's a buyer's market? Not quite sure yet. And for sellers, let me get rid of this thing right here. Boom. For sellers, well, there's fewer buyers out there looking for your homes, but there's fewer homes for sale. So this is a kind of something that we haven't figured out yet. Is it a seller's market or a buyer's market? How many months of inventory are there out there that are going to be bought and sold by existing home buyers? One odd example, I just got a call this morning from someone that listed their home Friday and had 3 offers over the weekend. So small little slice of the large pie there, but it could mean that it's more of a seller's market now, as there are more buyers out there looking for homes. Anyway, that's my update for this week. If I can answer any questions or help you in any way, please message me here, and feel free to share this. Have a great day. Bye.